Okay, thanks for joining us today. This is the consumer-centric panel, and on the stage today we have myself, James Goldstein, head of the retail group here at CreditSights, Todd Duvick, who heads up our autos, Jim Dunn, who heads up consumer, and Dave Bussey, who's our senior analyst on the leisure side. So before we dive into some sector specifics, let's kind of set the stage a little bit. You probably heard from our strategy team this morning. The Fed just gave us a pretty Goldilocks forecast for 2026. They actually took GDP growth expectations up 50 basis points to 2.6%, 2.3% rather, held unemployment expectations steady at 4.4%, and predicted just one rate cut in 2026. Our strategy team is less constructive with a base case of just 1 to 1.5% GDP growth, a higher unemployment of 4.7%, and calling for 3 rate cuts in 2026. And not to toot our own horn, I would never do that during bonus season when Chris Snow is sitting in the room. But I think a large part of I think this team, or at least part of this team, is a large part of the pessimism that's driving some of those weaker expectations from the strategy team. So we have a weekly meeting, and we sort of whisper in their ear the bad things that we're hearing from many of our consumer names. We know consumer spending is 68 to 70% of GDP, and like I said, that holds a lot of weight with how the economy goes. So what we've been telling them is, I think, a bit more negative than most. Fingers crossed that we get that right. But I guess let's start to unpack the consumer experience in 2025 and heading into 2026. I think opening question kind of for everyone, value seeking, I think, has become the buzzword of 2025. I'm tired of writing it in my research reports. Can each of you speak a little bit about what the consumer experience has looked like in your sector this year? And then as we enter 2026, are we seeing value seeking behavior uniformly across all consumer segments? Todd, I think we'll start with you on autos. Autos are a really big part of the consumer budget, whether that's through financing obligations, which seem to get bigger and bigger every month, insurance, which is now 50% more expensive than it was pre-pandemic, maintenance and repair costs, which keep going up. Can you talk a little bit about what you're seeing in new versus used vehicle sales and financing behavior, and anything else that you think would be interesting for the audience here to help us understand where things stand?
Sure. So if you take a look at what we've seen in retail sales so far this year, you wouldn't think anything is wrong with the consumer, because really retail sales year to date have been exceeding expectations. There are two primary factors for that. One is we saw the tariffs come into place in April of this year. So there's been a lot of pre-buying ahead of the expected increase in retail prices for automobiles. So we really haven't seen price increases materialize in a major way. So if you take a look at what happened in the April, May, June timeframe, we have an expectation for SAAR this year of 16 million units. In those 3 months, we saw about 16.8 million units, so actually higher than expected retail sales. So that's one factor. The other factor is there have been higher than expected electric vehicle sales prior to the expiration of the EV tax incentive at the end of September. So those two have really pulled more retail sales forward than what were expected. We've seen retail sales soften, but we still expect a SAAR of 16 million, which, just to put that in perspective, compares to the 4 years prior to the pandemic of about 17 million. So we're still not back to where we were pre-pandemic. I think a lot of that is because of affordability issues with higher prices and higher financing costs, but still 16 million SAAR, which is up from last year, is in pretty good shape, and we expect next year to be about flattish. So from a consumer perspective, we think that the consumer is in pretty good shape in terms of their auto purchases, most of which are financed.
Got it. Thanks. Jim, we'll turn to you on kind of the food and beverage consumer goods side. What's the tone out of food makers as we enter 26?
Yeah, it's certainly a bit weaker than what the auto sales might be indicating. And going into the year, that buzzword value seeking was pervasive primarily among low-income consumers. But as the year progressed, we saw incremental evidence that it was expanding into perhaps the middle income tier as well. And I think what's interesting about seeing weakness in consumer staples is that When the consumer generally weakens, they tend to do more things at home, including in meal prep, and that's generally a category tailwind. There have been administration headwinds, and then most recently you had the delay in SNAP. But for both food and beverage and household personal care, we saw a slowdown in categories that had been sort of the categories that you'd look at to be leading growth. Snacking, for example, OTC healthcare categories saw a slowdown. And I think a lot of it, has to do in part with the higher costs and food inflation. But we've seen the consumer just become increasingly discretionary in where they're spending. And more than just trade down, we've seen instances of abstaining from categories entirely in some even discretionary like food items, be it convenience channels or snacking categories generally. And then most recently, I think there's been some interesting comments from companies who've commented since the government shutdown, and they've seen another step down in weakness in October that's likely to continue into November.
Great, thanks. I mean, I can talk a little bit from my perspective on retail. I mean, the value-seeking trade down is definitely real in retail. I mean, if you look at Walmart, they keep saying the fastest growth is coming from higher income households who are trading into the channel. Private label growth has been strong across many of my names. So the value-seeking consumers are trading away from big brands. Off-price selling and warehouse clubs, are outperforming kind of the average group. So I think, for us, I think obviously we're seeing some parallel trends there. What can you tell us? I think one thing that stands out to me is kind of surprising, has stood out as surprising this year, is that restaurants, if you look at the retail sales data, restaurants are just kind of hanging in there, and restaurants are clearly a pretty discretionary category. What do we make of that?
Yeah, it's sort of a mixed bag in restaurants. Casual dining chains have seen weakness, and they've seen weakness sort of in that middle income consumer that seems to be trading down. If you look at a lower income restaurant company like McDonald's, they've seen weakness in the low income traffic, but they've seen a benefit from higher income traffic. And just to quantify that, last quarter they saw a high single digit decline in low income customers, high single digit decline in higher income customers. So there seems to be a trade down impact going on there. If you look at food distributors data, they show continued case growth count, but it's increasingly driven by new customer adds rather than penetration of existing customers. And we've wondered if there was an extended halo post-pandemic of new restaurant openings, given the massive amount of closures that happened during the pandemic. Intuition would tell you that we seem to be further enough away. We start to lose that tailwind, but we do wonder if there's still maybe a benefit in there. But there has been weakness in restaurant traffic throughout the year. But you look at the retail numbers and they're still up. So inflation's a big part of that. Restaurants have gotten more expensive. And then, of course, the higher income consumer continues to spend at a healthy clip. And that's in the numbers, at least, offsetting the weakness in the lower income.
Got it. It's probably a good segue to talk about leisure world. Dave, what are you seeing in the hotels and casino world?
Yeah. For 2025, generally softer across the board in U.S. lodging and casino. This softness really kind of took hold in April when tariff-related ripple effects across the consumer certainly added some caution on discretionary spending. But if we double click on that, what we're seeing is it's really happening at the lower tier hotels. And the value-oriented casinos in Las Vegas is like another good microcosm of this. On the flip side, the bifurcation shows that the higher end, there continues to be really solid demand for luxury hotels, upper upscale, and demand is actually up year over year for those different chain scales. So we're seeing a bit of a bifurcation, and one kind of byproduct of the lower tier being lower. And what we're seeing in the casino space is consumers that would typically go to the Strip in these value-oriented hotels like the Luxor, Excalibur, they're actually going to regional casinos. And so this is a trend that we've seen in the past. During periods of softer demand, regional casinos actually see a modest benefit compared to Las Vegas due to the lower cost to actually get to the casino. And consumers view a staycation as a more value-centric way to gamble their money.
Got it. So all sounding fairly K-shaped, and the kind of lower income being weaker and higher income
Yes.
holding out there. I mean, I guess kind of devil's advocate question is: does the lower income consumer really matter much? I mean, do we have names? Do you guys have specific credits that are more exposed to lower income consumers?
Yeah, I can start. Yes, and not so much. I guess yes, when specifically looking at issuers for us, that would include like Choice Hotels and Wyndham, who are significantly exposed to these lower chain hotels, economy and mid-scale, and we've seen their operations dip recently. Not as much in the sense of the broader market. Looking at demand for economy and mid-scale hotels, combined represent roughly a third of the overall market demand. So it certainly is a factor, but it's not the number one driver per se.
Yeah, even for arguably the more exposed low-income names within my coverage, and if you look at quick service restaurant categories, fast food restaurants, they're still growing sales, new restaurant openings, and higher income spenders are driving that. You could argue that every company in my coverage has exposure to lower income customers, and they're certainly feeling the pressure from it. So it seems to matter more. And what I think is more interesting, given recent developments, is that the category growth for CPG companies has slowed so much, and costs have gone up, price elasticities have increased, so margins have come under pressure. And so companies have to start looking at costs. And for the last few years, both companies have been focused on the margin generally because of the inflationary cycle, but we haven't seen any robust cuts in terms of manufacturing. Demand still remains strong, but we've seen weaker demand. And this week we have Pepsi telling its North American workforce to stay at home because pink slips are coming out. So we're starting to see signs of manufacturing tightening, I think, which is interesting. There was an activist involved in that example, but the demand picture's the same nonetheless.
Got it. Anything interesting for your names, Todd? And obviously, probably not a bad time to be selling Ferraris and Lamborghinis, but
True.
anyone feeling kind of the flip side of that?
Not really, but I think an interesting aspect in the auto sector is if you take a look at new vehicle sales, according to Experian, only about 3% of new vehicle sales are to subprime borrowers. So you're really talking about new vehicle sales being skewing towards the higher end. And if you take a look at what was talked about on the previous panel, the tricolor bankruptcies, the first brands, more so the tricolor, it's a subprime lender to basically undocumented immigrants. So they have two factors against them. That's really not the new retail auto market. Even the used retail market, which is about twice the size of the new vehicle market, they've got a higher exposure to subprime lenders or subprime borrowers, but still nothing compared to what Tricolor went through. So it's not a big factor for the auto sector in terms of new auto sales.
Okay. Thanks for that. Okay, I think so. We've kind of gone through the value centricity and sort of the K-shaped question. I think we can turn a little to inflation, which is one of everyone's favorite topics. I think we had some pretty major fears around tariffs reigniting inflation coming into this year. But for anyone in the kind of hyperinflation camp that had pictured us moving our cash around in wheelbarrows, it's been a little disappointing, right? We were running CPI at 3% at the most recent measure, which is delayed by the government shutdown, but not hyperinflationary. By any means. We definitely had some pockets, if we look across kind of consumer and retail, some pockets of inflation. We're starting to see sort of high single-digit inflation in the toys category, which is a very tariff-exposed. AutoZone this week reported 5 to 6% inflation at the kind of retail goods level and said there's more to come, down the road. Last year we sat on this very stage here and talked about eggs that were $4 or $5 a dozen, which was crazy. And then they got to $7 or $8 a dozen in February. And, everyone's mind was blown. Now eggs are back to normal, but beef is seeing high teens percentage inflation. Coffee prices are up 20% year over year. So there's definitely pockets of inflation. That got me thinking a little bit about elasticity, and it prompted me to do some digging around the USDA website last night, which is not a good idea. It's definitely, you can get lost in there. I was looking at specifically kind of like the beef numbers, because beef seems to be getting a lot of headlines. So I kind of had the question, well, what is the USDA predicting for beef consumption for the current year in the face of all this inflation? They don't actually call it consumption, by the way. They call it disappearance, which I found is a little bit weird. I'm like, who wrote this report? The Hamburglar from McDonald's? But anyway, the number that they're saying on volumes is down 1%, right? So you had 20% inflation and 1% decrease in the total consumption of beef. And this is across all the different cuts. We're not going to get into details. That's pretty inelastic, right? So my question is kind of like, do Americans just like to complain about high prices? And, why aren't we seeing more dramatic behavioral changes? And where are we seeing some consumers actually shift their behavior?
I can start since I'm technically the beef analyst. I think what's interesting.
I'm an ex-beef analyst. So.
Yeah, what's interesting to note about that, despite the demand environment that you described, is that the largest cattle processors in the U.S. are running at an operating loss. So in retail channels like grocery stores, I think you're seeing it show up in the numbers. Average sale prices are up, but volumes are way down, and there's significant trade down into cheaper protein alternatives, chicken in particular. So some of the high-end restaurant might be absorbing a lot of that, or food makers. But your question asks, where have we seen behavior shift? I have a couple of examples within food. Mondelez, which had been a higher margin, higher growth operator in the candy business, had faced 30, 40, 50% higher cocoa costs. So the price of chocolate was skyrocketing. And they sought to pass that through. And rather than seeing trade down, they saw examples of consumers just saying, well, I'm just abstaining from the category in particular. We started to hear, they were the first to say consumers are prioritizing on meal essentials over snacking. They've been saying it for 2 quarters now. So that's an obvious one. And the most recent quarter, they sort of, you mentioned what things we said last year. We sort of talked about how the consumer was just price fatigued, and we're seeing it even more right now. I think consumers are starting to balk at just the absolute value dollar cost of certain goods. A candy bar costs how much? Well, I'm just not going to buy it. So that's one of the more notable examples. And there's a couple other pockets where we've seen that throughout our coverage.
I can kind of piggyback on the fatigue. Las Vegas has seen such robust post-pandemic demand that some of their pricing actions got a little out of hand, and they've been a little slow to adjust. So we heard MGM CEO on the third quarter earnings call basically say, he took accountability, but he's like, shame on us. We're charging $12 coffees at the Excalibur, which is $29 room. And they also mentioned the infamous viral $26 water bottle at Aria. So they're aware of how their pricing actions have gotten out of control, and this fatigue has resulted in part of this kind of push from these value-oriented properties, instead of going to Vegas, going to regional markets. And so it sounds like they're adjusting, but the bad news is resort fees and parking fees at Las Vegas are here to stay, it sounds like. So definitely some fatigue in certain pockets of my sector.
Todd, any fatigue on is there trade down in auto size? Are people buying smaller cars? Everyone's still buying the big expensive cars? Anything?
They are. If you take a look at the average transaction price, it's reached a record in October, almost $50,000 per vehicle. Now there's a huge discrepancy all the way from $100,000 Suburban all the way down to $20,000 or $30,000 Chevy Trax. So there's a big disparity, but still, consumers are continuing to buy. And I think what they care about mostly is going to be the monthly payment. And we've seen some extension in terms of the duration, as well as we've seen a little lower financing costs, and also a slight increase in incentive costs or incentives for the vehicles. So, we really haven't seen much in the way of consumer fatigue in the auto sector, at least at this point.
Got it. It's probably the most American answer ever. Americans still buying cars and still eating beef, right? It's like we're doing America.
Yeah.
Okay. And I guess, so that's inflation kind of heading out of our companies. How about on the input cost side? How are your companies dealing with higher input costs? Obviously, raw material costs are up, labor costs are up. Has that, obviously that's been impactful for a lot of names. Who's got interesting examples there?
Yeah, I mean, for us, since leisure is so service oriented, the input cost impact from tariffs and inflation haven't been as meaningful, but where we're seeing it is the labor costs. And for a lot of our the names, the operators in our coverage, they're just kind of eating the labor costs or finding ways to get more efficient. For example, MGM, did an optimization of its workforce and essentially fired some concierge and replaced them with tablets at value-oriented properties. But outside of that, it's mostly labor, and it continues to kind of be a headwind.
What do you tip a tablet?
Tip a tablet? I'm not tipping a tablet.
James got asked to tip a robot made his coffee in Seattle once.
Draw a line somewhere.
I mentioned Mondelez as an example of where consumers have pushed back so much. It's an interesting thing, not just because consumers are expressing their resistance to absorb higher prices, so companies don't have the pricing power that they did. And you can argue that with the support of stimulus and increased SNAP benefits during the pandemic, that the industry went too far with price increases, and now they have to give pricing back. And we're actually starting to, Pepsi sort of leading the way and saying they might lower prices. But I sort of believe that when I see it, because they like to say prices are lower, but it's really oftentimes shrinkflation. The point is, though, as we talk about higher input costs, is that the pricing power isn't there. Volumes in a lot of cases are weaker, lower, and it's showing up on the margin. And so our expectation for the year to come is that we're going to see continued margin pressure because the pricing power just isn't there.
Got it. Todd, how's the margin story in autos in kind of the face of input inflation?
Well, so the margin story is terrible for autos, but that's tariff related. And so it's tough to pass along the tariff costs when you have a 25% increase in your cost just because of tariffs. However, there has, ever since the tariffs were initiated in April, we have seen them get less awful. There have been several bilateral trade agreements that have reduced the tariffs from 25% to 15%. There has been a parts offset relief package that has been introduced and then expanded. So that helps them as well. But I think the big factor for the automakers on the margin front is really two factors. One is it is helping for the time being to keep China out of the U.S. market, which is a very disruptive factor and is disrupting the European market, which could be a deflationary factor. But the other thing is regulatory changes are helping to reduce the regulatory costs, especially going into 2026. So as we take a look at the margin story for the auto sector heading into 2026, we view 2025 as kind of like a trough and improving in 2026 and then into 2027. So it's terrible, getting less terrible. And then finally by 2027, 2028, it's going to be back to normal or close.
Got it. Yeah, I keep seeing all these influencer reviews of Chinese EVs that they claim would be amazing if they could get to the U.S. market, and it would be, a third cheaper than Tesla competition. So
yeah.
That's certainly an interesting topic. We'll see what happens there. But okay, so I think we've established a bunch of sort of common themes. I guess I want to call out maybe some sector divergence. I think, Dave, certainly one of the ones that stands out. You cover the cruise sector, inherited it from Jim recently, fully, and it won't die. Like, how does that keep going?
Yeah.
So you have a somewhat value centric consumer base there, but the demand is just still, it seems unkillable.
Yeah. Jim, you covered cruise since before the pandemic, which feels like forever ago. So you can definitely attest to this. There's still a lot of headline volatility in the sector. But fundamentally, like what we're seeing from the operators and what we're hearing is forward bookings are still up year over year. Price is still stable, or yields are up slightly year over year. The latest concern is around the increase from Norwegian into the Caribbean and improving their family mix and what that could do to pricing in that region. But generally, what we're seeing it's resilient, and I think from like a fundamental standpoint, what's driving that resilience? I believe it's a combination of two things. One, there was a protracted recovery, so it was delayed, the timeline, versus hotels, which were back up really quick. So the cruiser base still has enthusiasm for cruising. And two, there is some value proposition to certain types of cruise. The short-term kind of Caribbean family mix cruise, they can be offered in bundled packages at discounts. The costs might include free cruise for your kids. So there is still a bit of a value proposition that if you're maybe a less affluent consumer and you still have a job, but you're looking to use your PTO, cruise is a valuable option.
Got it. I'll call out one from the retail side. We cover Tapestry, which owns Coach, and we're talking about value centricity and consumers being tired of high prices. These guys have been doing an amazing job pushing both volumes and price at the same time. So they're pushing mid-single digit inflation in their product offerings, but still getting significant volume growth. And I think it's a kind of a testament for like you have to play the game right. Obviously, it's a not a pure luxury game, not a pure luxury manufacturer, but it's stepping in certainly below price relative to the true Europeans. And they've kind of found their sweet spot. They've done a lot of work on the brand, obviously, as well. So, even in a tough environment, a well-operated company can actually thrive here, which I think is interesting. I guess we can just pivot a little bit to tariffs. I know we touched on it briefly. Tariffs are a big factor for retail, but I guess not all tariffs are created equal. For the retail, the major impediment has been on the IEEPA tariffs, which are the retaliatory tariffs, and those are actually being litigated before the Supreme Court, I guess, as we speak. And our internal legal team thinks that there's a fairly good chance that there's some reversal there. How it actually gets reversed, nobody quite knows. But I guess, Todd, your situation is a little different, right? You're largely in the Section 232 tariffs, and Section 232 has a pretty solid legal footing. They went through the right channels and did their perhaps fake analysis to show that there's real risks to the American economy. But they've done that, so those are not going to be easily knocked down. How have your names dealt with the tariff issue, and how impactful do you expect that to be into 2026?
Yeah, it's really interesting because, I think there was a broad expectation that once the tariffs were implemented, there were going to have to be pretty meaningful price increases to pass on the costs. And I think what we've seen is, for the most part, there have not been broad-based price increases. And in fact, in the most recent quarter, Honda reduced their full-year guidance in part because they said they were expecting more significant price increases, but the fact that the competition was not increasing prices materially, they kind of had to pull back their expectations. And I think that's because recognition that there is a fair bit of price elasticity here. And if you take a look at the pricing that we have today in the auto market compared to prior to the pandemic, prices are up 30% for new vehicles. So there's the realization that if they try and push through higher price increases, we're going to have a significant decline in retail sales. So, I think the tariffs, they're good and bad. And I think the automakers recognize that the good is that they do keep out China, at least for the time being. It allows them kind of a breather from a period in which they've invested heavily in electric vehicles, and the uptake of electric vehicles in the U.S. has not been good. So then now they can pivot back to where they're really making the money, which is in the gas-powered vehicles and the hybrid vehicles, where they have more pricing power. And yes, it's going to be some hurt in the near term, but I think it's going to be a much healthier market for them in 2 or 3 years than it was even prior to the tariffs.
Got it. Thanks for that. Dunn, your sector's, food and beverage is largely more domestically sourced, certainly than retail, which is almost entirely imported. But you're still, I was, looking at your Campbell's soup note from yesterday. They're still seeing some pretty large impacts. What's the story? What's the story there?
Well, I think the biggest takeaway, as you and I have spoke about, with companies like Campbell's and even Coca-Cola is the indirect impact of tariffs. So in Campbell's case, there's actually direct impacts because they have so much, they have exposure to steel and tariffs in their canned goods. But when you think about all that goes into making a food product, even if the overall cost of the can is a relatively small percentage of the end good, as we've talked about with aluminum in Coca-Cola's product, it still raises costs at a time when pricing power is weak and you're fighting for margin anyway. So even a 4% increase in COGS, which I think is what Campbell's expecting, driven in large part by tariffs, they can't pass that pricing through. So where tariffs are showing up most in my space are in indirect ways that you don't necessarily think about because it's not a direct tariff. Or an industry that you might think to be as exposed to tariffs, like autos, for example. But it comes at a time when pricing power has weakened, is weak, price elasticities have increased, and volumes going into this year hadn't stabilized from the last price cycle of price increases for cost inflation. So it's just sort of one more headwind on the cost front.
Got it. Dave, I think you're somewhat off the hook here. You have a bit more service-oriented industry. I guess probably on building materials costs, construction costs. Like there's got to be some impact for names that are actually building.
There is some impact. We saw Wind delay a project at its Encore tower because of tariffs, and it sounds like they're going to start the project in 2026 either way. But kind of going off Jim's point on like the indirect / side effects of tariffs, and one thing we've seen is the trade wars have certainly soured some of the international inbound travel flows. So what that's created is, currently U.S. citizens traveling outside the U.S. is pacing at like 130% of 2019 levels. Non-U.S. citizens coming into the U.S. was reaching around 99%. Since April, it's dropped back to about 85, 89%. So there's nearly a 40 percentage point gap versus 2019 levels. And where that's hurting is like Las Vegas, where there's essentially an informal boycott from Canada to travel to Las Vegas, as well as other urban and destination markets in the U.S. So, that's kind of one of the side effects of the trade war that we're seeing.
Got it. Yeah, I think on the retail side, on tariffs, it feels like we're still sort of in a wait and see or maybe a promise mode. A lot of our names have kind of started to rejigger supply chains, and then all the rates, the 145% Chinese tariffs dropped down to be pretty much flat, in many cases to what you would be paying on Vietnamese imports and these other kind of second markets that we're picking up share. And we have a lot of names that it feels like punting a little bit and saying, well, there's going to be some pressure. We saw a little bit of pressure in third quarter. You're going to see some more pressure in fourth quarter, but we'll figure it out in 2026. And I'm not sure they really have figured it out. I think they're kind of waiting to see what happens on a lot of these legal developments at this point before trying to push through all the price that they would need to recover some of those tariffs. I guess we can switch a little bit. Obviously, legislative impacts are significant this year. We had the big beautiful bill. I think we'll have to do the speed round. We only have 7 minutes left. I think for you, Todd, I think interesting changes. Auto financing deduction. I mean, if you answer in 10 seconds or less, is it a big deal for autos in 26? The deductibility.
So it's not a big deal, but it helps on the margin.
Okay. We've got tax changes coming down the pike. No tax on overtime, no tax on tips, wages, SALT cap reduction, maybe some bigger refunds in 2026. I'll answer that broadly for it. I mean, I think a little bit more money in everyone's pockets probably certainly seems positive. SNAP changes is one that Jim and I talk about a lot. One of the targets of the big beautiful bill was kind of reducing the size of the SNAP food stamp program. SNAP is 9 to 10% of overall food spending in the U.S. market. The changes there roll in over time. I think you're going to see your first impacts in 2026. There's changes to eligibility. Essentially, used to be if you were over 55, you didn't have to work. Now you have to be 65. They took away benefits for veterans, asylum seekers, a whole bunch of different categories. So incrementally, that program is going to start to see some hit in mid 26, and then to 27 and 28. There's actually a kind of a bigger push, which is to push back the cost of SNAP programs onto the states, and we don't know what the states or how the states are going to react to that. Are they going to fund it? Or are they going to try to back away from it? So that's certainly a negative. Immigration impact, I don't know, Dunn, yeah, I mean, on the labor front, you probably
immigration, labor. I think the most interesting thing is we've seen demand impacts for Hispanic customers. If you look at a company like Constellation Brands, which owns Pacifico, Corona, Modelo, they've repeatedly seen a slowdown in beer consumption amongst Hispanic customers. And we've seen a couple other names point to weakness in that demographic as a direct result of immigration enforcement.
Got it. And then I guess the last one, Todd, a bunch of EV credit changes. And then outside of the big, beautiful bill, you got CAFE changes, safety feature rollback, talking about taking out the safety features that make cars more expensive. Is that meaning, does it, automakers talk about that in meaningful ways? So this is real dollar savings for them?
It is going to be real dollar savings because they're going to have to, the forward look had been to pay a lot of fines for not selling enough electric vehicles. So that's gone. That was changed in the big, beautiful bill. And I think the other thing is we've already seen some write-offs for electric vehicle investments. We're going to see some more. GM has already signaled another one in the fourth quarter. We'll probably see another one from Ford. So I think, the whole cost structure, I think, is going to be reoriented towards a more profitable mix.
Got it. Okay. Those are helpful, I think. Kind of to pull it all together, before we get to specific credit recommendations, what kind of macro conditions are you guys underwriting to for 2026? Decelerating growth, an actual contraction, recession, everything's the same. We do have the Snap, Crackle, Pop was our title there. If you want to answer in the context of Snap, Crackle, Pop, that's up to you. I did discover there was actually a fourth character named Pow. So if you have a really bullish view, you can use Pow. He was an elf. He was dressed as a spaceman. So it only lasted for one season. So I don't know what that's all about. But yeah, how are you guys thinking about 2026 on the kind of the macro view overall?
Yeah, for our sector, we're thinking more of the same, if not some contraction. A lot of it depends on how unemployment shakes out through year end.
Same to weaker, more towards the pop category. All things point to at least current conditions continuing, but there's increasing sign of weakening as well.
Got it.
Yeah, I would say the same, slightly weakening, but rather constrained so that we don't see a big increase in default rates for vehicle loans, see pretty healthy demand for new vehicles.
Got it. Yeah, I think I'm in the Crackle, sort of getting by, but not seeing strong growth on the retail side as well. So we got 3 minutes left, which was our allocated time per person to talk about retail specific trade ideas. I'll start off real quick on names that we like in this environment. Dollar General is a name we've certainly talked about. Lower income consumer under pressure, but they're, as I said, I think I said earlier, they're picking up market share by consumers trading into the channel the same way that Walmart is. It's a deleveraging story that is playing out as promised. And while everything is tight in the retail space, in the IG space, you're getting paid 85 bips to be in the 8-year bonds there, which is certainly some spread pickup relative to a name like Walmart, which has that same counter cyclicality. So that's one that we like. O'Reilly, this is a hat tip to Noah on our team, who recently launched coverage on the auto parts retailers. Auto parts retailers is kind of a resilient counter-cyclical industry. I think some of the slow roll of the EV implementation will help. I think you're better off selling parts to fix gas cars than EV cars, and it has lower leverage versus AutoZone for the same spread. You get paid about 80 bips to be in the 34s bonds there. So those are a couple that I like. When we go down, Todd, why don't you go with yours?
Sure. Real quick, we like GM and Ford, the domestic automakers that we think will benefit the most from the changing regulatory environment. So we like those, and they're also the lowest rated among our sector. We think Ford keeps their investment grade, their negative outlook at low BBB by S&P. We think that gets revised to stable, not next year, but probably in 2027.
Yeah, I think we're trying to play consumer behavior a couple ways. So we've seen slowdown in snacking growth. We like companies that have exposure to meal categories. That would be Campbell's, or JM Smucker. JM Smucker also has a little bit of a deleveraging story. If you look at restaurants, we like McDonald's over Starbucks because Starbucks has premium price coffee and hasn't yet raised prices to pass through cost inflation, which we're going to have to do this year. So we're expecting some trade down there. There's also M&A considerations in our space. We have two major breakups going on in Kraft Heinz and Keurig Dr. Pepper. We would much prefer the Keurig Dr. Pepper story over Kraft Heinz because of what we expect to be legacy weakness of the Kraft Heinz North American grocery business and what we see as stronger fundamentals in the Keurig Dr. Pepper assets, coffee and beverages versus shelf-stable food.
I got 30 seconds.
30 seconds, go.
I'll give you two. Hyatt, we like. They're in a deleveraging cycle after some M&A in early 2025. What we really like about their portfolio is they have heavy exposure to international, 54% of the rooms, and the upper upscale and luxury hotels, 70% of rooms. On the flip side, we don't like Choice. They're the opposite. They have 90% exposure to lower tier hotels, 1% growth outlook in their pipeline, and we think they could look for M&A.
We did it.
Yeah.
We want to try. We'll try for Q&A if anyone has a quick question. Keep in mind that you're standing between everyone's lunch, and but no. Go. If anyone has any questions, feel free to ask. All right. We're also hosting a round table at 3:00. We have a special seasonal beverage offering from the consumer team, so feel free to stop by and have a drink with us. All right.
Sounds great.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.